Coming to you from the heart of Texas, this is Accounting Matters, the go-to podcast for accounting and finance professionals from your friends here at Embark. Thanks for joining us, y'all. I'm Nicole Harger, Embark's National Quality Managing Director. And as always, I'm joined by my co-host today, Adam Olson, Embark's Accounting Advisory Practice Leader.
How's it going?
Happy Monday.
Yeah, happy Monday.
We are talking about the new accounting standard that was issued towards the end of 2023 around accounting and disclosure for crypto assets.
Yep.
All right. Okay. So
which I know we've talked about leading up to, I think, for as this thing has been in development for the last couple of years. So we now have the finality. So yes. All right.
I don't think, have we done an episode?
We did do a past episode talking about the old kind of demystifying how historically crypto assets were accounted for, and probably talked more about the implications of the old guidance, which I know we'll talk about today. But I think at that time, the FASB was just exploring or starting to explore this project. So
All right.
Coming full circle now.
I'm glad you have a better memory than I do. Okay. So the landscape of accounting for crypto assets is evolving rapidly. And with ASU 2023-08, the FASB has laid down a new set of rules to help navigate this digital terrain. From defining scope to addressing remeasurement and disclosures, the standard brings much needed clarity to an area of accounting that's been maybe a bit of a wild, wild west. So before we really dive into the details of the new standard, let's provide maybe just a little bit of background on accounting for cryptocurrency under current GAAP. So currently, entities typically account for crypto assets as indefinite lived intangible assets in accordance with ASC 350. And specifically, the assets were measured at historical cost, less any impairment. And really the problem with this model is that it only reflects decreases in the fair value of crypto assets really until they're sold.
Right. Yeah, no ability to write the asset up. You could only write the asset down, and then any subsequent value in the asset actually couldn't be realized until it was essentially sold or disposed of. So yeah, so I would say from that, like, and this kind of tying back to what I was saying earlier when we had this conversation about the kind of old way, if you want to call it, for accounting for crypto, that did lead to the FASB back in 2021 when they did do their invitation to comment, doing kind of their broader agenda consultation, and the accounting for crypto did come up. I think if you think about the landscape of crypto assets a couple of years ago too, I think it was also a little bit more of a hot and kind of not saying that they've gone away, but definitely I think there's a little bit more maybe pullback on companies, transacting and using crypto as it was, differently 2 years ago. But they opened up that agenda consultation, and then one of the big items that was identified in that kind of invitation to provide comment on that agenda consultation was like, hey, the current accounting for crypto really does just not reflect the economics and merits of what we think holding these assets truly is. And what we mean by that is kind of what you were saying, where you don't have the ability to really recognize the value in real time around those assets. And you can only really recognize the downside of value through impairment, which is also complex and costly. And you can just think about a lot of the volatility that did exist in the crypto market. There was probably always constant triggering events under kind of that intangible asset guidance. And so companies were really having to kind of wrestle with probably constantly needing to do impairment analyses on their crypto holdings. And then at the end of the day, they didn't feel like they were really giving the relevant, users of their financial statement the information that they really need around those holdings themselves under that existing guidance.
Yep. Okay. And so kind of as a result of that ITC, as we mentioned, the FASB issues this new ASU that really is just around improving the accounting and the disclosure of crypto assets. So let's just dive right into the details of the standard. Kind of first, just hitting on the scope and who all the standard even applies to. The standard does apply to all entities that hold certain crypto assets. And so specifically, in order to be in scope of the new standard, there are really 6 scope criteria that must be met. The first is the crypto asset must meet the definition of an intangible asset under US GAAP. That's pretty simple. Second, the holder cannot have enforceable rights to or claims on underlying goods, services, or other assets. The third criteria is that the asset must be created or reside on a distributed ledger based on blockchain or similar technology. So fourth, the asset must be secured by cryptography. Mm-hmm. The fifth criteria is that the asset must be fungible. And then lastly, the asset cannot be created or issued by the reporting entity itself or any of its related parties.
Yeah. And I guess like, as you're talking about, it introduced this new scoping criteria, but like really what the standard also did is it just created a new subtopic as well within ASC 350. So now there's subtopic 350-60, which is for crypto assets. And I do think we'll see a lot of, certain types of crypto assets that will for sure meet that kind of first criteria that you mentioned. So around, is it an intangible asset? Mm-hmm. And then along the way, as you go through the next 5, it's going to fail somewhere. So in those cases, I do think it's important to point out that companies will still continue to account for those assets most likely under the kind of historical way of thinking about crypto asset accounting, which Correct. Is applying that indefinite lived intangible asset model where probably still subject to those impairment analyses based on triggering events and things like that, assuming it's indefinite lived. There's also kind of 2, I guess, categories of crypto related assets that I think are kind of important to highlight here. So one are NFTs, so those non-fungible tokens, and how does that fit into kind of this scoping exercise for this new guidance? And then this other one is around wrapped tokens, which I know the FASB, in deliberating the standard and even proposing the exposure draft on this standard, like there was discussion and the basis for conclusions around wrapped tokens. So maybe spend a little time talking about each of those. So just going back to the first one around NFTs, which non-fungible tokens, I think it's important that we kind of distinguish what does it even mean to be fungible versus non-fungible. And I think we talked about this when we did do our past podcast on just more broadly talking about like crypto assets and some of the characteristics of them, but just to maybe reemphasize there. So fungible tokens are identical, whereas NFTs, so non-fungible tokens, are considered individually unique. So kind of comparing and contrasting here. Fungible tokens can also be exchanged, whereas non-fungible tokens cannot be exchanged. And then kind of the last kind of dividing criteria is that fungible tokens are usually able to be divided up into smaller units, whereas kind of NFTs or non-fungible tokens are indivisible, meaning that you can't really take a piece of that NFT and send it or use it as payment or sell it off or whatever. You can only sell the entire token itself. So you don't have the ability to separate it. So that's important, I think, for companies to understand, especially if you're starting to get into certain crypto assets that are kind of outside the mainstream types that maybe people are more familiar with, and you get into more nuanced types of crypto assets, which we see from time to time is really trying to evaluate some of those characteristics. All right. And then the other type of kind of crypto asset category is around this concept of a wrap token, which, I think it's important to identify what it is. And ultimately what happened with wrap tokens is the FASB ended up not including kind of the definition or the concept of a wrapped token in scope of the final standard, at least explicitly. And I think that's because there really isn't a standard definition for what is a wrap token. And really, I think there's going to be a lot of like facts and circumstances evaluation. And that's because wrap tokens generally include a lot of other elements to it. So they, it could be a wide array of technological solutions, certain contractual rights, or other characteristics that exist with that asset. And because of those unique circumstances, there could be certain circumstances where this type of asset potentially could fall within the scope of this new standard. And then there's a lot of cases probably where it wouldn't, and it would be subject to other, accounting guidance, similar like the impairment model that we talked about. So I do think because they didn't directly address it, there's probably still going to be a lot of questions around those types of assets. So something that companies are still going to have to, even though this standard does provide a lot of clarity on kind of the broader categories of crypto assets, there's still going to be nuances where people are going to have to use a lot of judgment.
Yep. And I guess just one other thing to hit on, going back to the scope exception as it relates to crypto assets that are either issued or created by a reporting entity or its related party. That also would include those assets that, like, even if they were obtained from a third party, they still don't kind of qualify.
Yeah. So they definitely don't address the issuer accounting for crypto assets. So this is really more about holders of crypto is what this new standard is. And I think it, if I remember back to when they kind of did the invitation to comment on their agenda consultation, if you kind of go back to where concerns were raised, it was actually around how do holders of crypto assets handle it versus like issuers. So people that are like mining crypto or selling crypto on their own as part of their own business, like less confusion there around or maybe less concern about the existing accounting for that. So I think for a lot of people, there is precedent for how that accounting it should work. There's an AICPA cryptocurrency kind of guide out there that a lot of people use as kind of the unspoken, kind of word for how to think through some of those things. So definitely not covered in this standard, but something, if you are a company that tends to kind of issue your own crypto or mine your own crypto and sell, then, look to that guidance as well.
Yep. I think that is good context for our listeners to kind of help them understand and think through whether or not the new standard does apply to them. Let's move on to measurement. Okay. We've already kind of alluded to this. So the new standard does not address the initial measurement of crypto assets. So companies are still expected to initially measure crypto assets in accordance with the ASC 350-30, which is kind of your general intangibles other than goodwill.
Yeah, no, that's right. And the standard really is focusing on that subsequent measurement, right? So the remeasurement of crypto assets and how that should work. So theoretically, you can probably have a crypto asset because you're going to more or less measure it on a cost basis, maybe capitalize certain expenses into that cost basis, but then you're almost automatically going to have a remeasurement running through your P&L because it is not, most likely that cost basis is not reflective of fair value by the time you have to re-report. So likely a change there. But yeah, so the new standard is kind of stealing my own thunder here is the remeasurement does require that crypto asset, each reporting period to be measured at fair value. And those fair value changes are going to have to be recognized in earnings each reporting period. And so when you're thinking about fair value, it's not like they created anything new here. It really falls under the broader fair value framework. So ASC 820, which kind of sets the foundation for how we think about all fair value measurements within the financial statements. So no different here. The FASB felt like that existing framework provides enough context and that preparers are familiar enough with like the concepts and the judgments that need to go into making those measurements under that existing framework and could apply it equally to crypto. Because I think I remember reading this in the basis for conclusions as well, is that there were certain respondents that were like, they love the idea of having a fair value kind of remeasurement like solution here where they could do that, especially where there's active trading prices and it's pretty easy to do. But then they were a little concerned with, if you get into some of those more nuanced crypto type assets where aren't on an active market, less traded, more unobservable inputs, things like that. Is there a possibility where they could hold the old accounting where they would just be held at cost less, impairment or whatever? And the FASB pushed back on that and said, no, we have a lot of challenging level 3 fair value measurements that are already existing in US GAAP and a lot of financial statements. And so it's the same kind of, framework and the process you have to go through to evaluate and using those unobservable inputs to come up with a measurement. And that's going to be no different here, is that companies that have maybe harder to value are still going to have to apply that existing 820 guidance. Yep.
Okay. And I guess, so you kind of already touched on this a little bit, but one thing to mention is that, as it relates specifically to measurement, the new ASU doesn't actually address the accounting for any transaction costs that companies incur in order to acquire crypto assets. And so I think generally the idea is that you would still capitalize transaction costs based on the guidance in ASC 350-30 or ASC 805-30 for crypto assets acquired individually or in a group. However, the accounting for transaction costs may actually differ depending on the manner in which the crypto assets were acquired. So for example, transaction costs for crypto assets acquired in a business combination would obviously be expensed in accordance with ASC 805.
Yeah, and that's actually, so in the proposal, so the exposure draft for this standard, they actually did address transaction costs. And then it's kind of interesting because when the final standard came out, they took it out. And so In the exposure draft, I believe they were leaning towards that you would expense all transaction costs regardless. And now in the absence of that, I do think it does make, to your point, make sense that, look back to kind of the intangible asset guidance, because we're obviously in a subtopic within that intangible asset standard ASC 350. And so like you said, it's in many cases, it is going to be capitalized into that initial cost basis for those transaction costs, except when you're acquiring these types of assets in a business combination.
Yep. Okay, so I know we mentioned, at the beginning of the episode, the ASU also does cover improvement to crypto asset disclosures as well. So I think that was a good conversation around measurement. Let's kind of pivot a little bit to presentation and disclosure requirements that are now required under the new standard. So under the new standard, companies are now required to present on the balance sheet the aggregate amount of crypto assets measured at fair value separately from any other intangible assets that are not measured at fair value. And then from an income statement perspective, companies are required to include changes in fair value of crypto assets kind of separately from changes in the carrying amount of other intangible assets. So if you think about like your typical impairments or amortization, and this would also include other digital assets that are not measured at fair value.
Yeah. And I know some people were concerned around, I think we kind of talked about this, is just there's a lot of volatility, or there's historically been a lot of volatility with a lot of crypto assets in the markets. And so obviously concerned about if you're running those fair value changes through your income statement, just some of that up and down behavior that you could have. One thing the board did acknowledge was, and we hit on this a little bit earlier, was around just some of the net income volatility that you could have with applying this fair value measurement or remeasurement, I guess, in this case for subsequent measurement to your income statement. And so I think a lot of people just need to think about, and this is kind of the board's point of view as well, is that holding a crypto asset is very similar to kind of holding like an equity security. And so as an investment, at least. And so, there are readily determinable fair values in a lot of cases, or one that can be derived under ASC 820. And so that's inevitable, is that you're going to have some of those fluctuations. One thing they did not really stipulate is kind of where those fair value changes. So, obviously you're reporting that through earnings, but like where in earnings do you actually present those changes in fair value? Whether that should be considered operating or non-operating. And so there could be some facts and circumstances that are needed to use there. I think generally there's a viewpoint that these things should be reflected in operating, similar to other investment holdings. And so absent explicit guidance on that, I do think there is some judgment that can be used there, but I would principally assume that a lot of companies are going to reflect remeasurement, kind of fair value changes in operating, as well as any gains or losses from selling an asset as well. Typically would be done through an operating type expense line item.
Yep, that makes sense. And so, okay, I guess from a statement of cash flows perspective, presentation of in-scope crypto assets would follow, the existing guidance in ASC 230. However, if crypto assets are received as non-cash consideration in the ordinary course of business, and so if you think about like settlement of receivables, and then they are nearly immediately converted into cash, the new ASU does specifically require that the cash received be classified as an operating activity in the statement of cash flows.
Yeah, and they even go into kind of drilling into what does it mean like nearly immediately. But that really is meant to be a very short period of time. And so I think they even allude to like that could be convertible to cash within a few hours, or at maybe max a few days. It's not meant to be like a few weeks or something of holding that crypto asset before that conversion happens. So just thinking about the context there, if you are going to apply that guidance and put those cash flows into operating based on that assumption that nearly immediately, it has to be pretty quick. Also, reporting entities may acquire crypto assets for trading purposes. And so although the new ASU does not specifically address the presentation of these trading activities in the statement of cash flow, I do think principally, again, here, you tend to see those cash receipts and cash payments purchases of sales of those kind of investments are going to be reflected in operating cash flows in accordance with ASC 820.
Okay. Well, I think that maybe covers it from a presentation perspective, kind of pivoting and moving on to disclosure requirements. As part of this, there were additional disclosure requirements for crypto assets. Do you want to kind of start diving in and telling our listeners what those additional requirements are that do apply to both annual and interim periods?
Yeah. So, and maybe backing up just before that, I would also say because these assets are now subject to kind of fair value measurement guidance in ASC 820, you'd also would have to apply the whole host of disclosures, or at least include these in those whole host of disclosures that go into ASC 820. But then in addition to it, what it specifically calls out here. So for interim and annual periods, obviously you need to disclose any significant holdings of crypto assets, as well as any restrictions, if you have those, on the sale of those crypto assets, each interim and annual period. The way you think about significant, whether it's a significant kind of crypto holding, it's going to be tied to the fair value of that holding. So just kind of thinking about it through that context. But typically what you're going to include in there is going to be the name of the crypto asset, what is the cost basis for it, even though it's going to be held at fair value. So cost basis, but then the fair value. And then in addition, the number of units held of that particular crypto asset. You also have to disclose the aggregated kind of cost bases and fair values of crypto assets that are not individually significant. So if you don't call out a specific one, but you kind of have this other pile, also addressing kind of what reconciles those other holdings back to your total, probably balance sheet line item for crypto assets. And then again, I mentioned the contractual sales restrictions that exist. So, an entity will need to disclose which of their crypto assets potentially have any of these restrictions on them and the values of those crypto assets. But then in addition, really explaining the context behind some of those restrictions, like what are they? How long do they last? Do they ever last? What is the nature of that restriction, et cetera, just so that people can really kind of understand some of the behaviors around some of those crypto assets and maybe potentially how long someone might hold that asset for before there's a potential to sell it, or do they even have the ability to sell it? What does that look like? So just kind of putting more clarity to users of the financials around some of those restrictions.
Yep. So the standard did also include, annual reporting disclosure requirements only for annual periods, not necessarily for interim periods. And so as part of that, companies must disclose the cost basis method that was used to determine the cost basis of any crypto assets that were disposed of when calculating the gains or losses. And then specifically also the income statement line item in which those gains or losses are included in if they are not presented separately. So in addition to that, companies must also disclose a reconciliation of their holdings in crypto assets. And so for the annual reconciliation, this includes disclosure of any crypto asset additions, disposals, the recognized gains and losses and net income, all determined on an individual crypto asset by crypto asset basis.
Yeah. Yeah. And I will say, and we've talked here a bit about gains and losses. So I just want to slip in, like, those are going to be accounted for and measured under the guidance in ASC 610, kind of how you think about disposing of other assets and things like that. So just if people were curious how you apply to measure that gain or loss, it's going to be using kind of just that broader framework there. But then going back to your reconciliation kind of comments about including that disclosure on an annual basis. So then there's also some requirements around some of the reconciliation activities. Really just having to describe what some of those activities are. So if you think about additions that would be included in that reconciliation, so any purchases, receipts from customers, or if you happen to be a crypto miner and you get additional crypto through those activities, really kind of describing and disclosing kind of the nature of those activities. And then the same thing on a disposition side. So crypto sales you have, or if you use your crypto assets to make payments for services or goods or things like that. Really also kind of illustrating just some of those disposition activities. And then lastly, it's really just around, explaining total amount of cumulative gains or losses that are realized during the period. And then really explaining, where on the income statements you're presenting those gains or losses so people can kind of reconcile back where those amounts are characterized if it's not already explicitly called out on its own.
Yep. Okay, so we've covered what needs to be done. Let's kind of move on to the when and how companies need to adopt the standard. So as a reminder, we touched on this at the beginning of the episode, but it does apply to all companies. So public, private, nonprofit, employee benefit plans. And so all scope entities are required to adopt the standard for both annual and interim periods beginning after December 15th, 2024. Early adoption is permitted as long as financial statements have not been issued or available for issuance.
Yeah, I feel like I've already seen some clients starting to early adopt and apply it this year as well. So, and then just from a transition perspective, it will be applied on a modified retrospective method. So you'll have that cumulative effect adjustment recorded to your opening balance of retained earnings as of the beginning of the year of adoption.
And so with that, I guess we can wrap up today's discussion. It's clear that the world of accounting is embracing the digital revolution. So whether you're a seasoned CFO or just starting your career in finance, staying up to date with these changes is key to success in our ever evolving profession. The accounting rules for crypto assets are quickly changing, and the FASB's ASU 2023-08 does introduce new guidelines to manage the digital landscape, and the standard, as we kind of talked about, offers clear definitions and rules around scope, remeasurement, and disclosures, which does bring much needed clarity. So as always, thank you for tuning in to Accounting Matters. Be sure to subscribe and stay tuned for more insights into the fascinating world of finance and accounting. Until next time, keep crunching those numbers and stay curious.